Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We have now kicked earnings season into high gear, so let's go ahead and get started and take a look at what's moving the markets. Now, before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, for those of you that are trading options at Firstrade, just to announce, they recently just launched a new iOS and Android platform. I've used it myself. It's really made options trading a lot easier on your mobile phone, being able to input complex orders from the options chains, being able to edit those orders and replace those orders on the fly very quickly without having to cancel and replace those orders, and managing our complex options positions are now all easier on this new iOS platform. So for those of you that are trading options, I highly recommend that you take a look. So on the agenda today, I want to first talk a little bit about the market update. We'll do a brief overview of the few major names that have started to report this morning, predominantly JPM, Delta Airlines, as well as talking a little bit about Pepsi, the price action we're seeing around that, how that's going to be put into context around the earnings season and what we're expecting out of earnings season, and talking a little bit about the sector review. So we're going to do a sector review of all the sectors, showing you where we currently see some rotation in the sectors, and hopefully that'll help frame your longer term views here for the markets here. So the question is really, can markets continue to break out higher, or is the markets going to respond to COVID-19? Those are some of the things we want to discuss here today. My name is Tony Zhang. I'm the chief strategist here at Options Play. I've spent the last 14 years of my career working with retail and institutional clients, better understand the markets and how they're currently performing based on technical analysis. And recently, over the past 8 years, as an option strategist, helping people understand how to leverage those directional views that they have in the markets, utilizing options to do so in a way with limited risk. So today we're here to discuss what's currently going on in the markets, what we're seeing moving the markets, and what is likely going to happen in the future. So let's go ahead and get started by taking a look at the overall market. So we've been talking about this 317, 318 level here on SPY for quite some time. We've referenced this exhaustion gap that we saw up here from about a month ago when markets managed to break above that 317 level, could not hold it for more than just a few days, and came crashing back down. That's typically what we call a bit of an exhaustion gap or an island top here. Now, markets tried to break out above that level yesterday in the morning on relatively strong optimism that earnings was going to be a strong season. Traded all the way back up to almost that 323 all-time relative high we saw here on the island top. But in the afternoon, after the news came out in California, rolling back a lot of their reopening plans and closing down bars, restaurants, and movie theaters, markets sold off fairly heavily as a result of that. Now, we did have some earnings this morning that equalize this, if you will. JPM, Pepsi, Delta all reported earnings between yesterday and today, relatively decent earnings, I would say, given the backdrop of what we're currently seeing. But this certainly puts the market back into this more neutral zone between 300 and 315. Arguably 310 and 317. We're trading in a very narrow range right now between 310 and 317. Breakouts above that level or below that level will likely see some further gains. Likely we're going to see earnings season push the markets one way or another. We'll discuss some of the early reports and kind of what we're seeing from there. Technology took a big hit yesterday, but we've been talking about this negative divergence because as markets continue to move higher, momentum is not confirming these moves higher. They're actually continuing to move lower. So technology taking about almost a 2%, a little over the 2% decline yesterday, resolving some of that momentum, bleeding off some of that momentum before it can continue moving higher. That's whether that certainly may not necessarily be strong, but that is healthy for market to see this type of rotation, because you can't just have a single sector like technology drag the whole market higher. That's not what we consider a healthy market rally. You need for strong sectors like technology to bleed off some of that momentum, weaker sectors start to catch up before markets can continue to move higher. So the sector rotation that, as we're going to discuss here today, is something that we'd like to see in order for markets to continue moving higher. Small caps starting to lead again. The question is whether small caps is starting to lead again. Small caps has really fallen behind a little bit over the past few weeks in this triangle, but however, we see that small caps is starting to break out here. Small caps pre-market up about 1%, while the broader market is basically flat. So small caps starting to lead the market a little bit here again. So this is, again, signs of the type of sector rotation that we want to see, or market rotation that we want to see, that's healthy for markets. Equal weight continues to lag here. The RSP, which is the S&P 500 equal weight index, still lagging behind. So there are still some concerns as far as the health of this market rally right now between the equity markets. So this is some of the concerns that we currently see, and this is one of the reasons why we're not as bullish and believing that markets are going to break above that 317, 323 and continue higher. Now, if we take a look at TLT, this is the 20-year Treasury bond. Gains here in this particular ETF tell us that there's still quite a bit of safe haven demand here. So we've had this really strong move up in safe haven demand ever since the January highs. We've had a recent market consolidation for quite a few months, and now TLT is starting to move higher again. This is telling us that risk off and safe haven demand remains relatively robust. You see this across Treasury bonds. We also see it across gold. But looking at volatility has really been stuck here in this 30 range. So this higher volatility environment that we have not seen in many, many years is here to stay. We've had this pretty much range here in VIX between 25 and roughly 35 or so, with a few spikes in one direction or another. But really 30 is the new 10 as far as volatility goes. And we expect this volatility to relatively remain as long as you still have a lot of uncertainty around COVID-19. I think you're likely going to see volatility remain fairly elevated all the way through the election in November. As I was saying before, safe haven demand, this is really providing a bit of a tailwind here for gold. Gold being traditionally what we would consider more of an inflation hedge, which certainly is a concern for a lot of investors, especially as the Fed continues to pump liquidity. They are currently buying directly on the open market with fixed income bonds, of corporate bonds, at a pretty decent clip, somewhere between $50 to $100 billion a quarter. And the tailwind of the safe haven demand here for gold is really just continue to push this asset higher. Now, again, for gold, one of the things that we don't necessarily expect is a strong breakout here, but GLD, or gold itself, all-time high at $1,900 an ounce. That's our target to the upside here for gold. And we think that's going to be more of a slow grind higher here rather than a breakout higher that we've seen on many other assets. Crude continues to struggle with this $41 level, and we are becoming less and less confident that we're going to see that breakout here in crude above that $41 level. We're starting to see some moves down, what seems like momentum starting to wane and starting to move lower here, because as you can see, as oil continues to try to break above that $41 level, momentum is slowing down, money flow is slowing down both on the daily and weekly level. This is concerning for oil. We're also seeing the fundamentals of oil not look particularly strong. We're seeing investments being pulled out of this particular sector. It's still one of the weakest sectors it is the weakest sector in the market. And we're going to take a look at XLE here in a few minutes and showing you where we see in terms of trends here for XLE. The one bright spot that I want to point us to is silver. Silver managed to recently break out above a pretty significant triple top here around 17 and a half. As you can see, this level goes all the way back to September of 2019, January of 2019, and we finally managed to break out after what was a pretty significant decline here in silver. So silver is more of an industrial demand metal. It's not a safe haven demand. So the fact that we have a breakout here in silver is somewhat indicative of the industrial demand that we are starting to see a ramp up in other markets. So however you want to take a look at this, You could look at this as an inverted head and shoulders from a daily perspective, but relatively strong chart here. You have a very, very steep, if you will, channel here that is now broken above a major resistance level. We think silver will continue to outperform gold here. There's still quite a bit of room to the upside here on momentum. So watch out for silver and especially for XLI, the industrials for this particular name. Now, earnings calendar. This is really earnings kicked into high gear this morning. You had Pepsi yesterday that reported that was a little stronger than expected. The stock rallied, but didn't really move much higher. You had JPM that came out this morning significantly better than expected, but just to put into context, JPM's report was still 50% decline in revenue compared to the same time last quarter. That is the type of effects that we've seen COVID-19 have on the broader market. JPM, Citigroup, Delta all reported this morning here. We'll just take a quick peek here. JPM did move a little bit higher. What was particularly strong on JPM was their trading revenue, M&A activity. JPM up about 1.3% pre-market. Citigroup is actually down pre-market, having not as strong earnings, but it was actually up about 2% earlier today. So Citigroup looks like not gaining as much strength pre-market after that earnings announcement. Delta also down as a result of losing about $1.6 billion. I'm sorry, losing close to $5 billion after making roughly 1.5 the same time this year. Last quarter, same time last year in Q2. So the outlook here for airlines, very, very bleak here as a result of what Delta reported this morning, what they're expecting for the rest of the year. They're not expecting corporate travel to pick up anytime soon. They don't expect at the end of this year or even beginning of next year for corporate travel to pick up, and Delta Airlines has quite a bit of exposure to that, whereas opposed to domestic, discount travel is certainly expected to pick up a little quicker than corporate travel. So Delta fairly exposed to that. So if we look at the price action of all of the reports, most of them have managed to beat their earnings expectation, including Pepsi. Pepsi had a pretty strong earnings call yesterday. The stock traded up a few percentage points, but as you can see, it's still stuck in this range between 130 and 138. It has not managed to break out above it. Now, when you have a strong earnings report that is not able to move this stock significantly above this range, and this is arguably what we are expecting here from this particular quarter. Even stocks that manage to beat their earnings expectations are less likely to see some significant gains to the upside simply because of the sheer reduction in terms of revenue. Even though they might be beating earnings, we're still talking about revenues many times 30, 40, 50% declines from the same time last year. So we don't expect stock prices to move significantly higher, and this is part of the reason why we feel that SPY is likely going to struggle to get above this 317, 323 level. Anything above that, we would really need to see some significant reversals in corporate earnings in order for that to happen. And at the moment, that is not what we're currently exactly seeing. So we have Goldman, we have Wells Fargo's later today, Goldman, a few other banks tomorrow, and then we get into Bank of America, Johnson & Johnson, Morgan Stanley, and Netflix on Thursday. So those are some of the ones to pay attention to for the rest of the week. Next week, we start getting into some other bigger names as well, into across the other sectors. You have Lockheed Martin, you have Philip Morris, some consumer staples with Coca-Cola, Texas Instruments, some technology stocks, biotech stocks, Microsoft, Amazon, Intel. So you have some heavy hitters next week coming up. So this week we have about 20% of the S&P 500 reporting. Next week we have almost another 20% reporting. So we have quite a bit of information flowing in over the next few weeks, important pieces of information to keep an eye out on. So with that, let's take a look at all of the sectors. We haven't taken a look at the sectors yet in quite a few weeks, so I wanted to take a look at it because we've been talking about the health of the market. What is heavily tied to how the sector how much sector rotation we see. Over the past few weeks, sector rotation has almost been non-existent. You really just had technology stocks, dragging the markets higher. We're starting to see a little bit more sector rotation, so we're gonna take a look at the sectors here. So technology, one of the things we wanted to point out on a long-term chart, and that still is concerning to us, is this major negative divergence we're seeing on the weekly chart. Arguably, yesterday we saw a little bit of that starting to resolve itself, where you have, as markets continue to move higher, momentum no longer confirming those moves higher, money flow relatively weak. So we're starting to see technology bleed off some of that momentum. However, technology still remains above those February 2020 highs or early February highs. So we could get a pullback to those levels and potentially for the markets to continue to move higher. So this is what I would say healthy for the technology sector. It has gone a little too far too fast. It needs to bleed off some of that momentum in order to continue moving higher. Consumer discretionary, very strong sector, but again, this is one of the sectors where we do see a lot of concentration in terms of a few big names. You have basically Amazon, Home Depot dragging this market higher. You have a bit of a triple top here. What did break out above that triple top here yesterday, but however, as you can see after the breakout, traded lower back below that level. So as of right now, that triple top still holding. We can see potentially a breakout higher above this and for this to continue moving higher, similar to technology. But again, that breakout has not happened yet, but it is on the verge of that. So keep an eye out here for consumer discretionary after bleeding off some momentum to continue moving higher here. Very similar story here in communications, but arguably communications much stronger on the fundamentals. This is a sector that makes sense as far as why it's breaking out and so strong, because communications is one of the sectors that has heavily been impacted and has, I guess, a bit of a tailwind as a result of COVID-19. You have names like Amazon, Netflix, all the ISPs. These are names that are like companies. So the fact that it just squeaked below that resistance level, I think that you're likely to see communications find support around that level and continue to move higher. So communications, certainly one of the stronger sectors, in my opinion, here for this particular market. XLV continues to gather strength, even though over the past, I would say 2 or 3 months or so, has really had made no progress here. So really actually lagging behind the overall market. But yesterday showing quite a bit of strength here, one of the few sectors that was still positive on the day after the news out of California. It is still below that 102.5 level. Breakouts above 102.5 and 105, which is the all-time high here, would put healthcare in a substantially higher or bullish state here. I will say that, you know, pharma, if you think about the healthcare space, healthcare is a pretty big blend of different names in this particular sector and in industries. You have hospitals, you have managed care, you have insurance companies. So XLV is a mixed bag here. If you're looking for strength within the healthcare space, IBB Pharma may be more of a concentrated name and provides additional outperformance that you're not quite seeing in healthcare, because again, healthcare more of a mixed bag here in terms of what it is, what is included in that particular ETF. Materials actually has been surprisingly strong, especially over the past few weeks here. As markets kind of move sideways, materials continue to gather strength. This is interesting for me because you have a pretty steep move to the upside without any real consolidation. You have a brief consolidation here and it's starting to move higher. So materials still within this $54 and $60 range. You really would like to see a breakout above 60 for materials to continue moving higher. But again, one of the sectors that are gathering strength, as you can see on the daily chart, you have positive momentum. Positive money flow on both the weekly and the daily charts. The momentum indicators are nowhere near overbought, so you have quite a bit of room to the upside here from a momentum perspective. So this is one of the sectors that has surprised me a little bit as far as how much strength it has managed to keep up, because I really think of materials and industrials in relatively the same camp, and industrials significantly weaker here than materials. Consumer staples. This is another sector that, while has been underperforming the market and hasn't been particularly strong, from a relative perspective has started to gain a little bit of strength here. And this makes sense as far as when markets continue to be a little jittery on COVID-19, that consumer staples or more defensive stocks are doing relatively well. As you can see, XLP trading near that resistance high here around $60 or so. Breakouts above this level but would put us potentially back all the way up into the $64, $65 range here. So XLP, certainly one to watch in the next few days if it breaks out above the 60 and a 60 and a half level, if you will, on XLP. As you can see on the weekly chart, you have a very tight trading range here after what was a pretty big move to the upside. This type of sideways consolidation, again, is healthy for the markets to continue moving higher. And we are trading near the upper bound of that range, gathering some strength. So you could see a breakout here in XLP. XLU, this is a sector that is similar type story to XLP, but has recently been losing some strength here. The consolidation, a little bit, upward trajectory, but as you can see, trading near the bottom of that range here. So XLU, not particularly strong, trading near the bottom of the range. Momentum also looking fairly neutral, if you will. Money flow not particularly strong. So at this moment, we're still neutral, but I would watch for a potential breakout here to the downside, especially here as XLP starts to outperform XLU. So for more defensive play, utilities not providing the same type of defense as staples. Real estate, this is one that has started to continue to weaken as well. From a fundamental perspective, it makes sense as to why real estate is not particularly strong. It is trading, if we think about this triangle here, near the apex, near the bottom of that triangle. Now, this could potentially break out to the upside. However, from the fundamentals perspective, does not look particularly strong for a breakout to the upside. More likely that you might see a breakout here to the downside. You have targets to around $30 here to the downside here for XLU. XLU losing momentum, trading below the 20-week moving average. It has some major support here at the 200-week moving average, but again, breakdowns below that can bring this significantly weaker here to the downside. Industrials, as I said before, materials and industrials, similar industries. However, industrials looking significantly weaker, but it has managed to stay above the $65 level. So, but as you can see, it is pretty weak here after managing to break out above 65. It has just consolidated into a weaker and weaker triangle. Likely it's going to break down to the downside here. But again, that silver chart before showing us that there seems to be some strength here from an industrial demand here. So it is possible that here on XLI, we get a surprise to the upside, especially with earnings coming up, that we could see that move to the upside here. So, but I'm watching that triangle, looking to see if we get some moves one way or another. But if you can see here on the weekly chart, money flow looking very weak, daily chart money flow looking very weak. That's part of why my base case is for industrials to actually start falling lower here. But perhaps silver telling us something that the charts here is not. XLF, this is a bit of a bottoming formation here. XLF as similar to the XLI chart, but actually now below those major support levels. The question is whether we see the rest of the week between Goldman Sachs, Morgan Stanley, some of the regional banks that are going to be reporting over the next few days rather, if that can start pushing XLF higher back into that $27 range. XLF, one of the big things that I think that we took away from this morning's report from JPM is that that they've had significant declines in terms of revenue due to interest. Their net interest margin went from about 2.3% to about 1.99%, and that is going to affect all of the major banks, regional banks. And if we think of JPM as best of breed in terms of being able to capture any type of volatility from a trading perspective, being able to capture M&A and deal activity through their investment bank, despite all of that, JPM is only up about 1% here as a result of that. You have plenty of other banks that don't have trading desks and have not been able to take advantage of the market volatility and turn that into revenues. You have plenty of regional banks or even major banks that don't have as strong investment bank divisions that are likely going to see some significant reduction in terms of revenues as a result of interest rates being significantly lower. And you couple that with the fact that many of these banks have had to set aside billions of dollars to account for souring loans that they expect to materialize over the next few quarters. JPM setting aside $10.5 billion to account for loans that they think are going to go bad over the next few quarters. You know, that type of numbers may be what actually causes XLF to continue moving lower. So XLF just hanging on by a thread here above that resistance level. But again, I think that it's more likely that you could see a move to the downside here, especially as the rest of the regional banks that don't have a strong trading arm, don't have a strong investment banking arm that has kept JPM kind of earnings relatively strong. Those other financials are not going to be doing as well. So financials, one of the weakest sectors. And lastly, energy. Energy, as I was showing you before, cannot manage to stay above that $41 level in terms of oil prices. Energy tried to rally above that gap high, but failed. And we're starting to see the formations of what I would call a bit of a head and shoulders top here, and likely that you're going to see XLE continue to move lower. This sector does not look particularly strong from a fundamental perspective. The amount of downgrades we're seeing in this particular sector account for almost 30 to 40% of all downgrades in the S&P 500, while this sector only represents about 4% of the S&P 500. So this sector fundamentals look extremely weak, and the price action here on the chart reflects that, and we think that there's going to be further downside momentum, money flow, everything looking extremely weak here. So this is one of the sectors that is weak and is likely going to continue being weak. So that's a quick wrap up of the sectors, what we're currently seeing, and I purposely did the sectors from strongest to weakest, just so you can see the progression of which sectors are strongest, which ones are in the middle and starting to rotate either higher or lower, and lastly, which ones are the weakest at the very end. So pay attention to the earnings season that's coming up over the next few weeks. Like I said, XLF banks this week is going to be the primary driver of the markets. If banks cannot continue to move higher, likely we're not going to see markets break above that 317 level. That's our base case for now. I hope you guys find this useful for your trading day. Thank you so much for your time this morning. I hope you guys have a great trading day.